The next topic that we will discuss is leverages. What is a leverage? What do you mean by the term leverage? Leverages is it refers to a relation between two interrelated variables, or you can understand the leverages can be understood as an impact or amplification which a particular happening could cause on the other thing. So what are the types of these leverages? Leverages can be understood as in three parts. Let's understand the very first part, which is your operating leverages. What does an operating leverage or operating leverages measure? It measures the relationship between revenue, your gross revenue generated, to your earnings before profit and tax, before your tax and interest. So you can say that your operating leverage is contribution, which is your gross revenue, only with sales minus variable expense, whole by EBIT, which is your earnings before interest and taxes. Similarly, your degree could be measured as percentage of change in your net income upon percentage of change in sales. What do you mean by this operating leverage? Operating leverage means what is the change, or how many times is your contribution affected by a change in your EBIT. Similarly, by a change in your sales, how much or how many times is your net operating income changing? So in other words, it measures the change in income due to operations and its operating activities. Such advantage or such a amplification which a company enjoys is nothing but operating leverage, or this is measured by operating leverage. So what is the other type of a leverage? At the end, the other type of leverage is your financial leverage. Your financial leverage, it means a relationship between earnings of a company to earnings of a shareholder. At the end, a shareholder has to be concerned that his earnings need to be increased. So we will calculate a financial leverage as earnings before income, before interest and tax, by earnings before tax. And your degree of financial leverage can be measured as a percentage of change in EPS, which is earnings per share, upon percentage of change in EBIT. So it just measures, like we discussed for operating, it measures how many times. So it says how many times does your EBT change with every change in your EBIT. So similarly, when you talk about a degree, it says how many times does your EPS change with the change in your EBIT. In other words, it can be said that it measures the change in your EPS with the change in your gross earnings of the company. Means if the company earns more, how many times does the EPS, how many times does the shareholders' earnings increase? Because at the end, shareholder doesn't get all the earnings, he just gets the EPS, which is the earnings after deductions of the interest and all the fixed liability. So the last leverage is your combined leverage. Like the name says, it is a combined leverage or the combined advantage which a company faces, which can be calculated as operating leverage when multiplied with your financial leverage leads to a combined leverage. So it could be formulated as combined leverage is nothing but contribution upon EBT. So this measures nothing but the total advantage or total amplification that the company enjoys. So like every rupee which the company earns, how much does its EBT increase? EBT is nothing but the shareholders' earnings, which are nothing but only meant for shareholders. So with leverages we can measure the advantage that a company has, which could be either because of its operations, or it could be because of its financial capital structuring, or it could be a combined because of both. So your leverages measures nothing but the advantage or the relationship between two things, and most of the times the relationship is to be determined to get your earnings for the shareholders. By how much money, if I'm earning, is my shareholder getting out of it? That's it. Thank you.